Hi, I'm Lydia Wietzma with Revelation Real Estate, and today our podcast in Solving Life's Next Chapter, we have two of probably my favorite people, Aimee and Ted, and they are with RMF Financial. So thank you and welcome to the show.
Thanks, Lydia.
Okay, so tell me a little bit about, we're really talking about reverse mortgages today, but that's kind of a lot of people think reverse mortgages and they think bad connotation. So what is the new name of it is called HECM, correct?
Right.
And what does HECM stand for? So tell me that first.
Well, it's not a new name.
Okay.
It's really become more of the norm because people don't want to say or hear the word reverse mortgage.
Right.
But HECM is HECM.
Okay.
Stands for Home Equity Conversion Mortgage.
Okay.
And it's what the government has named the program.
Okay.
So when you hear the word HECM, that is what the product is.
Okay.
And been around 30 years.
Okay. So that being said, kind of give us a quick history of where the reverse mortgage and the HECM, give us kind of where it started and how it's kind of gotten to this point.
Well, where it started, it started back before even the Reagan administration.
Okay.
But Ronald Reagan and his team decided to really implement it back in the 80s.
Okay.
Yep.
So
1989, they implemented the FHA insurance fund.
Yeah.
Okay. So
And
that's
it's
kind of when it
insurance
started was
It's
around
when it really became a
Mainstream.
government protected
Okay.
insured program.
Right. Okay.
So
Okay.
the FHA insurance fund was established in 1989 under the Reagan administration.
Okay,
So-
gotcha. Okay. So give us, I know it's hard to explain what it is, but tell us kind of as easy as you can, because our viewers are not financially savvy. So kind of give us, if you can, the easy version of what is a reverse mortgage or HECM.
Well, it is complicated. It can be
Okay.
a complicated seeming product, but what it is it's a mortgage tied to your home, just like any other mortgage, except this one is insured.
Okay.
So there's an insurance fund tied to it, and it protects you. It
Okay.
protects you from having to make a monthly payment. You
Right.
can, but you don't have to.
Right.
And when it becomes due and payable is when you leave the home.
Okay.
So it's pretty simple there's just so many different ways to use
Right,
it.
right.
Yeah.
There are, and probably the biggest, the word that gets thrown out in our industry a lot is non-recourse.
Right.
And what
That's
that
those protections.
just to simplify, what that means is the insurance fund protects you from any debt against the home above the value of the home. So it's an insurance policy that protects you from ever being in a debt situation against the home.
So that being said, if someone were to buy a home or refinance a home for say $400,000, that's what their home was worth, and they get about 50% of it. Let's just say $200,000, and then let's say that they use the funds up, or the funds aren't there anymore for whatever reason, and then the economy tanks and the house is worth below that 200,000.
Right.
So tell us that basically ensures that they're not going to get kicked out of the house. Is that
Right.
basically
It insures
correct?
a lot. Actually, it ensures they won't get kicked out. They
Okay.
can live there as long as they keep the property up. They have
Okay.
to, pay taxes and insurance. If there's
Right.
an HOA, they have to pay that.
Okay.
But if it doesn't matter on the value of the home, if you've got that mortgage in place and the insurance is protecting you, you can stay.
Right.
So, and if you needed to sell or you wanted to sell, or even if you passed on and the home was no longer being occupied, the insurance fund that's tied to this loan is protecting you. You can, if the house is worth $1 and your loan is worth more than that, you can hand the keys over if you want,
Right.
or you can call you and figure out,
Yep. Yep.
how you could sell the house.
Right. So how I explain it to clients when they're kind of asking me about it is I tell them that they can either give the keys back for the family. If someone's passed away, they give the keys back, or the family can buy it themselves, or the family can short sale it at that time. So the family has options if the senior has passed, basically.
Correct.
And then there's also options when the senior has not passed and say they want to move from their home to an assisted living, kind of the same thing. They can either sell it and or just give the keys back.
Yep.
Is that
Right.
correct?
Yep.
Okay.
Right, and nobody is responsible for that difference. Nobody being the homeowner or,
Or the
the
family.
heirs, the
Okay.
family. Nobody. Yeah, that's what the insurance is there for.
Okay.
It protects. It's
Right.
the coverage.
Yeah, now about 3 years ago, they changed the lending tables. So on average, the lending tables on a reverse mortgage are roughly 50% of the value of the home,
Okay.
based off your age.
Right.
So if you have a $500,000 home,
Right.
and you own it outright, there's availability of, say, $250,000 in equity,
Right.
to utilize as you see fit.
Right.
The tables were changed, so really the way that HUD wants this program to work is you're never underwater.
Right.
There's always going to be value in that asset, but it allows the people to live, or the person to live in that property without having the burden of making a monthly
House.
payment
Yep.
against a loan or against a home.
Right.
But they really want it at the end of plan.
Right.
They really want there still to be an equitable position in the
Right.
property. So
Okay.
they want to call up Lydia,
Right.
and they want to say, Lydia, give us fair market value in our
Right.
home. Let's pay this loan back, and let's take back
Right.
the additional $100,000
Right.
out of the property into the estate.
Yeah.
Yeah, and I have sold a lot of homes with reverse mortgages, even the old reverse mortgages, and there has been some equity left in it, depending on
Yeah.
how the person uses the funds and that kind of thing. So as a senior real estate specialist, I know that a lot of my clients are house rich and cash poor.
Right.
That's usually what happens. And I think it's gotten worse as our economy was bad 10, 12 years ago. People lost their retirement funds at the time, and they lost a lot of things to the stock market, and they just don't have the money coming in other than maybe a Social Security, a small pension, and that's all they've got to live on. So a lot of times they are not eating correctly or they're not air conditioning their home in the summer or heating it up in the winter because they can't afford it, basically. So they're living on very tight funds. And so that's when you guys can come in and you can either, there's 4 ways of basically doing a HECM, basically, right? So let's kind of go into that and explain how this could help some of those folks in different capacities.
Okay.
So you tell me which one you want to start with.
Well, I'll go through them very quickly,
Okay.
and then we can come back to them. So a HECM, a home equity conversion mortgage, is really one product.
Right, okay,
It has numerous features on how you can pull the money from the product.
okay,
We call in our business at RMF, it's the 4 common uses of the reverse mortgage or of the home equity conversion mortgage.
Okay.
The first one is if you right now have a mortgage against your property,
yep,
and let's say the mortgage is about 50% of the value of the home today.
right,
You can utilize the reverse mortgage to pay off the mortgage, and it puts the people in a position where they pay the mortgage off, and now they do not have to make a monthly mortgage payment
Okay.
against them. So they can redirect those funds to use in retirement.
Right.
They can continue to make payments, but this
Right.
loan gives them the flexibility not to have to make a
okay,
payment. So
gotcha, okay,
that's use number 1.
okay,
Use number 2 is house rich, life poor. Let's say they have all their money tied up in a home, but they own it outright.
okay,
What they can do is they can open up what's called a reverse mortgage, home equity conversion mortgage line of credit.
okay,
Very similar to a home equity line of credit.
okay,
The difference with the reverse mortgage line of credit is it will open up about 50% value
okay,
to the asset. So if you live in a $500,000 home,
okay,
it'll open up about a $250,000 line of credit.
gotcha,
The cool thing about it, and there's different ways you can have the money get paid to you
Okay.
out of that line.
Okay.
The cool thing about that line is once you have it in place, it is protected. It cannot be canceled or frozen.
okay,
And it grows every month of the expected interest rate on the loan, which right now is averaging between 4 to 5%. So you've got a line of
Okay.
credit that's growing. The unused balance is growing on a monthly basis, which
Okay.
Very cool.
is
Yeah.
very.
Yeah.
It opens
that's
up.
probably the coolest part of this product.
Financial planners love it, and that is the one where it really has lack of education.
Right.
But what financial planners are saying is, why don't we open up that up for future? Let's
Right.
You may not ever need it, but let's open it up in case you do.
Right,
The third common use is what's called so you implement the HECM,
okay,
but then you have what's called in our business they call it a tenure, TENURE, which is to us it's a lifetime payment plan.
okay,
Where your home sends you a check every month,
okay,
tax free,
Okay.
for as long as you're alive in that home.
okay, up to whatever the
Supplemental-
amount is. So it's like a supplemental income if someone's
It-
down maybe just to their just a little bit of Social Security, basically.
That's based off of your age, the age of
Right.
the youngest borrower in the home.
Okay.
And then it's also based off of the home value. So
Okay.
there'd have to be an appraisal, and you get your numbers that way.
Okay.
And then the final one, where we have a very strong relationship with
Yep.
you, is a lot of individuals are using this product to buy a new home
Right.
when they're going to right size.
Yep.
And we always recommend, speak to a senior real estate specialist like Lydia or to a financial planner. But to really kind of simplify how it works, you come to close with about 50% down
Right.
of the purchase price.
Okay.
So a $500,000 home, you come with $250,000.
Right.
You write that check.
Right.
You own the home, you have title on the home, you don't ever have to make another monthly mortgage payment for as long as you live in the home.
Right. So let's give them an example of that. So recently we just closed on, not too long ago, there were sisters that were living in a large home together. One was in process of going through hospice, and she ended up passing away. So what people don't realize, or what I should say what younger people don't realize, is that when you're either a spouse or siblings like these two sisters, you have two Social Securities. And when one of them passes, you only have one Social Security. So now you have all these big house expenses that you have to pool person, garden person, air conditioning, heating, all these different things, taxes on these bigger houses. And we were able to basically sell the big home, find her a smaller, more economic home with just one income, but we bought it through the reverse mortgage, and she ended up having money in her pocket besides not having a house payment.
Life-changing.
Life-changing.
Yep.
And that's what's so exciting about this particular product, is there's some ways to utilize it correctly to where you have good quality of life, and actually even better quality of life than what you were living in before. So
It's really unlocking that equity. So
Right.
the people that own the home outright, they don't have a mortgage payment, but they're
Right.
sitting in their $300,000 house.
Right.
It can unlock about that 50%. They have access then to about that 150, where they
Okay.
can extend their retirement. They can
Yeah.
talk to their financial advisor and really make smart choices.
Right.
It's not about a last resort. It's
Right.
about a savvy, smart business tool. And it's money. It's money that's sitting there that you can absolutely change your life in retirement by using it.
Right, right.
So-
I think what has really been like life-changing for so many people is, it used to be years ago that all of us would recommend, you use your 401ks and all your money out of your retirement first, and then you sell the home.
Right.
And there are statistics that show that if you do the home equity or the
Reverse.
reverse first, take that out and save your money in your 401k, you actually end up with more money.
You do.
Is that correct?
It is.
Yeah.
It is. There's a couple really good examples that I'll try to get through quickly without putting people to sleep. The first one is, if you own your home outright, putting the line of credit vehicle in place where you've got a standby line of credit and an access point to the equity in the home if you need it.
Right.
The way financial planners are utilizing that, or they're saying to their clients, put these in place. Once they're in place, let's not use them until we need them. When we start to enter a bear market and you have people that are living off their retirement portfolios, the financial planners are tapping into the home equity to
Okay.
live off of, to
Okay.
leave the portfolios alone in a down market, because they don't want to pull with a diluted share. It's
Right.
sequence of return strategy. So they're pulling from the line of credit to live off of.
Right.
They're letting the market recover. When the market recovers, they're pulling back out of the market to pay back down the line
back
of
the
credit.
loan, yeah.
So, and they're showing that they can extend.
Extend the portfolio and retirement for up to 25 years. There's been
Wow, it's really that
25
long?
years.
Yeah, there's we won't pull any of the educators' names out, but yeah,
Right.
there's research articles that have been developed on this by people in
Some
Financial
big,
planning.
yeah.
financial
Yeah.
planning world. Yeah,
Big,
so,
big.
And the
people
numbers
in
don't
it.
lie.
Right.
So, I know that this has some negative press. There's been some
Right.
people that absolutely don't even want to hear about it.
Right.
But I encourage everyone to open their minds, to
Right.
listen and really get a good idea of how this works. Because, again, and I know this sounds cliche, but it's absolutely apparent in all of the loans I've been involved with, it is a life changer. It
I've
changes
seen it
your
too.
mind
Yep.
and the way you're able to live in retirement
Right.
after 62. I mean,
Right.
you know,
And people don't realize that a lot of times you're in a situation where you don't know what you don't know. And
Right.
and the old reverse mortgages did have some bad. They did change them over the years because one of the bad things that they started out with is if you had a spouse that was 62 and one that was younger, if that one that was 62 got the loan on the home and passed away, the younger spouse was basically kicked out of the
Right.
house. And that has changed as
has
well.
changed. Yeah.
So if you are a younger spouse under the age 62
Mm-hmm.
and you do have a reverse mortgage from your other spouse and they pass, they can't kick you out of the home.
right.
Is that
They're
correct?
protected now.
Yep.
Yep.
They are,
Okay.
They are protected.
And that was probably one of the biggest problems that
Yeah.
reverse mortgages had way back when.
It, I would say from what I've seen in all the studies, probably the biggest thing that we run into is you still have to pay your taxes, your
Right.
insurance, your HOAs, and maintain property.
Right.
If that doesn't happen, you get yourself in trouble.
But you have to pay that no matter whether
No matter
whether you
what.
even don't have
Right
a
on.
mortgage
Right.
on your house. They will an HOA
Right.
association will put a lien on the home. The tax people will put
Yep.
and the tax people come first, so they will put the
Yep.
first on before your HOA.
Yep.
So I mean, you
Yeah.
have to maintain those things
You do.
anyway.
You
so.
do. You have
Right.
to. That's a big one. It
Right.
really is. And you know the other changes that they made is they've decreased the lending tables.
Right, okay.
Which there's difference of opinions on that, but it's strengthened the equity position in these homes for a longer period of time.
Right.
They also changed, which I think was very necessary, is they've changed the calculations on origination fees
Okay.
and the calculations on how you can charge on these loans. So it's
Okay.
it's a protected,
Much more
regulated loan.
Right.
regulated, yeah.
And it needed to be because there
Right.
were some reverse mortgage companies out there that were gouging people
Correct.
when they really
Yep.
didn't
Mm-hmm.
need to. So that is another issue that they are more, we have to let people know right up front.
Right.
They are more expensive because you are prepaying some of that insurance up front,
Mm-hmm.
but you are protected once you do it. So, so tell us, what is the basic guidelines on these reverse mortgages?
On what like the eligibility guidelines?
Yeah, eligibility guidelines.
Well, and you backfill as I miss them here. We have a private label program. It's
Okay.
called Equity Elite, and the minimum age for that private label reverse mortgage is age 60. And the reason I bring that up is you're going to see an industry shift where
Okay.
there's going to be more development of proprietary reverse mortgage products. Same what's called non-recourse provisions, the same protections.
But those are good so those types of loans that your company obviously offers is good for those that need it but aren't quite 62.
That's one of the
Yeah.
benefits of it, and I won't get granular on it, but there's some other really, what I think are really strong benefits of the Equity Elite private
Okay.
mortgage condos. There are several
Yes.
condos that will not,
opens up.
that will not
won't
qualify.
go normally. Okay,
Right.
with a regular
with the
reverse.
HECM,
Okay.
with the government, the
Right.
FHA has some stipulations on what kind of property can
Gotcha.
have this loan.
Okay.
So the private ones are able to be on more properties.
Yep.
Right. Okay.
For the HECM, the Home Equity Conversion Mortgage, which is the FHA insured program,
Right.
age 62.
Okay.
Can't have any bankruptcies or federal liens over the past, can't have any federal liens, but you can't have any
Right.
bankruptcies over the past 3 years.
Okay. 3 years.
It does not follow debt to income ratios. It's not a qualified mortgage, so
Right.
it does follow a financial assessment. So you have to show you have enough income
Okay.
To maintain the home.
to
Okay.
maintain the home and pay
Which-
any debt liabilities. that you
Okay.
have.
Which would be the taxes and the HOA and,
Right.
and that kind
Yep.
of thing.
Yep.
Okay.
It follows a financial assessment.
Okay.
Probably similar to a VA.
Okay.
But you don't have to have an actual employment
Right.
income to qualify for this loan.
Right.
So that's what makes it a non-qualified. Is it you can use your Social Security check as your income.
Yep.
You can, and the stipulations are a little bit. They're changed. They're for the 62-year-olds.
Right.
The blips on your credit, if you have some blips on DROG
Right.
credit, it does not disqualify you.
Okay, that's good to know. That's
So
great to know.
Everybody wants to have a great FICO score, but just
But you don't have to have a perfect one to
exactly.
get it.
If you don't have a
Okay.
perfect FICO score, you're not going to get disqualified to
Gotcha.
take out a reverse mortgage.
Right. Right.
It has to be your primary residence.
Yes.
Can't be a vacation property. You can own multiple homes.
Okay.
You can only have one FHA insured loan.
Gotcha. Okay. So that actually brings me to another question. So I get a lot of folks in the senior industry that I work in where they're considering getting a reverse mortgage, but they're concerned because one of the spouses looks like they might be moving into either assisted living or memory care. And I did not know this till I spoke with you about it, that they can actually put the reverse mortgage on the home as long as one of the spouses lives in the home. My example was, so last week we had the executive director of Fellowship Square, John Scott, here, and they have independent assisted and memory care in their community, but around the corner they have these small little 2-bedroom, 2-bath, like little patio homes where someone could sell the big home, put their loved one in the memory care or the assisted living, and then they could buy,
Be right beside them.
be right near them.
Nice.
Yeah.
Yep.
So that's kind of one example that I try to give people, because I think they're nervous about getting a reverse mortgage because they think they're going to have to sell it here fairly quickly to do something.
In fact, we suggest the reverse mortgage probably should be put on the home that you plan to stay in for the long haul.
Okay.
For, a good 7 years. I
Okay.
think there's a TALC, total annual loan cost.
Okay.
And with the fees that are associated with this loan, we
Right.
definitely suggest someone stay or plan to stay in their home as long as possible.
Right. Okay. So what are some of the questions that your clients come up with when they're considering buying or using one of these reverse mortgages? Because I know I get a lot of these strange questions. What about this? What about that? What is some of the big myths that you guys come up with that people just don't understand, and because it's either they thought about it or maybe something happened and they think that it is, but it's not. So tell us what some of those myths are.
I would say the biggest one that we run into are family members concerned that they're going to be straddled with debt.
Yeah.
And there's just a misunderstanding. Nobody, if the debt ever exceeds the value of the home, that's what the mortgage insurance premium pays for. That's why you put a reverse mortgage in place. That's the primary reason you put a home equity conversion mortgage in place. So
Right.
I would say that the misconception of now that I've done this, the lender owns my home.
Yes, I get
false.
that a lot.
That's not true.
I don't own my home anymore, and they're
You have a loan, just
Right.
like any other forward mortgage that anybody's ever had. You have a loan, but the difference is you're not having to make that monthly payment.
right.
So if you don't make a monthly payment, the loan's interest gets tacked on. And so month after month, it's getting tacked on that you're living there and you're not making that mortgage payment. But you've
Right.
only got about half of your money tied up in your home, not 100%.
Right.
So you've only got, half of it approximately.
Right.
And it's getting tacked on, and so you move away in 10 years. Well, that interest has been building. So
Right.
this is what we call a negative amortization loan.
Okay.
So it's getting bigger. The loan isn't getting smaller because you're making payments. The loan is getting bigger. And now when you want to leave, it's due and payable.
Right.
So that's where you hope that you sell the house with a great
For
realtor
more,
that
yes.
you can get a great price for.
Right.
And you pay off that loan, and you walk away with still that inheritance
Right.
or the legacy that a lot of people seem to be really concerned
Right.
with. They don't want to not leave their legacy.
Right.
Which,
Yeah.
we've talked
Right.
about this before.
Yeah.
A lot of kids want their parents comfortable.
Right.
They
Right.
really do, and they're not so concerned with the house. They just
Right.
want to make sure mom and dad are taken care of.
And I think that's probably the myth that a lot of the seniors have, is they think, oh, my kids want my house. They really don't want your house.
No, they want you
want the money
happy.
from the house,
Right.
really, ideally, but they really want you to be taken care of, and that's really
Yes.
what the main thing is.
And we absolutely, we ask people that are deciding to get into these, if they have children, please involve them. We have some people say no.
None
but
of their business.
Right.
And that's
We-
okay too.
Yeah.
But
we really, the kids need to know about it.
Right.
Because, Aimee brings this up quite a bit. You get yourself in a position where you have loss of parent or parents.
Right.
And during all of the cleanup process, if you figure out that there's a reverse mortgage that's been tapping into what you thought was perceived inheritance,
Right.
it causes problems.
Right.
It
Yeah,
just,
not
it
only
just
are you
does.
grieving,
Yeah.
but now you're completely blown away with what
Right.
was or what is versus what you thought it would be.
Exactly,
So-
exactly. I think it is important. One of the stipulations of getting the loan is they have to go through some sort of counseling, correct? So tell us about that.
That is correct. Go ahead.
Well, FHA and even our private product, we need to have anybody who's getting one of these loans, the homeowners, to sit in a 60 or 90-minute counseling session. Depending on your questions, it can go as long as it needs to, but you have to sit in with a third party,
Okay.
a HECM counselor, to learn and make sure that you're understanding the product. It is a mortgage, so it's a loan. They really want to make sure everyone who's getting this loan knows what they're getting.
Right,
So
right.
there's been a lot of people in the past that with the negative press that say, I didn't know that's what I was doing. I didn't
Right.
know that's the way this loan would work. Well, to alleviate or to fix that, they've decided let's put them through a third party counselor,
Right.
not associated with any lender.
Right.
It is someone there to really make sure that this person or these people are aware of what they're doing.
Right,
So-
and it's a pretty extensive, they go through what a reverse mortgage
Right,
is.
how it functions and what will happen when it's due and payable, because that's
Right.
always what everybody looks for. They love the idea of no payment.
Right.
You know, I would change my life, and it would be great to not have a mortgage, but they're very concerned, and rightfully
Right.
so. But they're very concerned what happens at end of plan.
Right.
We call it end of plan. So depending, whenever you're done with the home, whatever
Right.
happens to make you done living in that home full time. And that's what's good about the third party. I think,
Right.
again, these are protections that have been put in place
Right.
to strengthen the program. It really makes it so safe, and they want everyone to know.
Right,
Yeah, and the third-party counselors have nothing to do with the lender.
okay,
That's
that's good to know.
we can't tell them who to use.
Right.
We give them options.
Right,
We give them options not only to do it over the phone or do it in person,
right,
but we've had situations where after counseling sessions, it was determined that this probably isn't the best product for us, and
Right.
that's fine.
Right.
We would rather have that happen then rather than down the
Too
road.
late,
It's
right.
Too late.
Now, the one thing I do know is that I try to explain this with people when I do like seminars, is that a lot of times, people are living longer and they don't have all their health care taken care of. So this is a way of keeping the payments down as far as the government is concerned. It's a way of using their home to basically live off of or take care of not financially but health-wise for that reason. So
Absolutely. Once you open the asset into the home, so if you have substantial equity in your home,
right,
or the other side is maybe you only have 50% equity in the home, but
Right.
you have to get rid of that monthly mortgage
Right,
payment. You
right.
need to redirect that $1,000 to $1,500 a month somewhere else.
right,
But if you get access to, if you own your home outright, you get access to the equity in that home.
Right.
You absolutely can use it for custodial services.
Okay.
Or supplement instead of the long-term care insurance. You have
Right.
that money as an access point if you ever need to go grab it.
right, right.
And again, if you put the unused line of credit, if you just put a line of credit in place,
Right.
you don't need it today.
Right.
You don't know what's going to happen to you tomorrow.
Right.
That line's growing.
So the ideal situation is to get the 62-year-old to get the line of credit put on the home right away at 62,
Yeah.
not touch it till they're closer to 75, 80 if
Right.
they need it at that point.
Yeah,
Right.
as long as they're, as Aimee stated, as long as they think they're in their end of plan home.
Right.
A long-term home, for
long-term
sure.
home.
So say you're
Right.
62 and you go and you own your home outright. You're one of the lucky ones. So you own it and you put this reverse mortgage in place in the line of credit.
Right.
So then you're going to unlock probably about 40% because you're
Okay.
the youngest. So
Right.
the younger you are, the less
Money you get. Okay.
So you would unlock that 40%. So okay, $300,000 house, 40% help me. What is that? You're going to unlock about 130, 140.
140, yeah.
Okay.
So let's just use 140. You're going to unlock just that amount.
Right.
And it sits there and you're not using it. So next year it's going to be 145. Then 5 years from now, it could be 160. Don't hold me to that number. I don't
Right,
know on my
right.
mouth. But it's growing in your favor so
Right.
that the longer you don't use it, the more is available for you to use. So
Right.
you're 80. We've run numbers out where it's astonishing how fast that nest egg, I'm not even probably supposed to use that word, how that number grows.
Right.
It's the
Yeah.
compounding interest. It's
Right.
amazing. So
It-
you open up just this, and no matter what the housing market is doing,
Right.
that line continues to grow at
Is
that
still
expected
growing.
rate.
Okay.
It's amazing.
And just to restate, it cannot be canceled or frozen.
Okay.
So even if us as a company goes out of business,
Okay.
it gets repositioned.
Yep.
Okay.
And it continues the growth pattern for as long as you live in that home. We have a financial planner presentation where they ran in Money Guide Pro, and they put these numbers in, and they showed a couple, I believe it was a little over a $600,000 home. They put a reverse mortgage in at age 62,
Okay.
which is
Line
what you
of credit.
suggested.
Okay.
Put the line of credit in place.
Yep.
By the time they were 82, that line had grown the value in that line had grown up about $1 million.
Wow.
And let's say we're in a housing market where you're hopeful that house is going to appreciate above that
Right.
mark in 20 years.
Right.
But what if it doesn't?
Right.
That $1 million line is still there, irregardless of
Yep.
the value of the home. The home could have had zero appreciation, so
Yep.
you could have a home at $600,000
And it never gets
and a line at $1 million.
Wow.
The $1 million line's
Yeah.
available to you. Oh, and guess what? If you have to borrow against that line and sell your home, the mortgage insurance premium pays the difference in debt.
There you go.
So-
There you
We
go.
love having everyone talk to their financial planner about
Yeah.
this because at the end of the day, the numbers don't lie. It is a viable product. When
Right.
used smartly, it can really benefit.
I've seen it myself, so
Yeah.
I do know
Yeah.
I do know what you're talking about, and it's really hard because a lot of not only folks don't understand, but even real estate agents don't understand reverse mortgage enough to even offer it to their clients when they're trying to buy a home because they just don't get it. And if they could buy a home and not have a house payment, that could be a huge thing for some people.
Well, a lot of people. Oh, go ahead.
No, after you.
A lot of people say it's too good to be true. If it's
Yep.
too good to be true, then it probably is. It's not. This is insurance that you're buying on this mortgage.
Right.
You
We
are
have-
protected.
When we have a client in the purchase space, this is a fairly old client, not by age, but
Right.
it happened
From
a
long
while
time ago,
back.
Right.
Yeah.
But they had millions of dollars in a portfolio to
Okay.
retire off of. Decided they were going to buy their end of life home.
Okay.
The home value was a smaller home for them. It was nothing fancy. The home was about $300,000.
Okay.
They were coming in an all cash position. They were going to
Okay.
write $300,000 to buy this home.
Okay.
Financial planner got to him and said, "Why would you pull $300,000 that we could try to keep a portion of it in your plan
Right.
and put it on your home?" So what they decided to do, rather than put $300,000 in the home, they put $140,000 in the home.
Okay.
The Heck'em for purchase paid the incremental one, the additional $160,
Right.
and they were able to leave $160,000 in a multi-million-dollar portfolio. And the planner runs the numbers,
Right.
and as Amy stated, the numbers don't lie.
Yeah.
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 It just made sense to
Right.
not put all their money in that home.
Right.
So
They could more than
Pe-
afford it, but it was the smarter financial
was- right.
decision to use this loan.
To do that.
Yep.
Okay, great.
probably too far in the weeds on it, but
Well, it's exciting though.
And people just don't know, including real estate agents.
Right.
You obviously do, that this tool can be invaluable
Absolutely.
in the right situation.
Absolutely. I have seen it, and I know you guys have both seen it too. I've seen it change lives it for the
Yes.
better. It's never, I've never seen a negative on this particular
Even
loan.
at end of plan, right?
Yes, even at end
it
of
is
plan.
designed to be so safe.
Yep.
It just
Well-
needs to be understood.
Exactly.
And I want to get this out so we don't miss it before we're out of time, but the other misconception is once you're in this loan, you're done. You're in this loan. No, you're not.
Right.
You can refi this loan. You can
Yep.
pay this loan off. You are never stuck in this loan. As Amy stated earlier, it's just a loan. At some point, it's got to be repaid.
Right.
Right.
And I like what you have told some of my clients is you can take this loan and buy this house with it, and you can slowly, if you want,
Right.
pay it down.
Super flexible,
If
too.
if say something happens and you get a big bonus or something, and you want to pay some
Yep.
of it down, you can do that.
Mm-hmm.
That's one of the nice options that you've got at
Right.
this point.
Absolutely. And it's we call it in our business flex pay. Most people don't use it.
Right.
But if you are doing a flex pay, you not only can you pay it down, but you can pay up a line
Okay.
that's accessible to you. And the interest rates
Yeah.
are very, very much in line with conventional rates today.
Yeah.
Pretty competitive.
And that's what's nice is if it's going to, if you're going to pull it out to have it as a safe net for later on, it gets that interest, which is much better than a bank would give you at this point.
Right. Right.
So,
You know, I'd love to I'd love for the numbers to be lower, where people could come to the table with less
Right.
money. But that's one of the big things. We get a lot of people that are interested in this loan, but they just don't meet that threshold, that
Right.
number. So I just wanted to make it clear that you have to have about a 50% equity in your home, or you've got to have access to about that 50% value of the home to actually
Right.
make this loan work for you.
Right,
So-
and you can always, you can get with an agent like myself, and we can run some just general numbers until you get the appraisal. You don't want them to pay for an appraisal if they don't have to, if it's,
No,
that
right,
makes no sense.
right.
So,
Well, and with you on this product, your buyers can get pre-approved on this just like they can a conventional
Yep.
loan. So they you can get a credit approval on these. You still don't have to use it, but we oftentimes will say, go ahead and do it. Put the
Right.
credit approval in place. That way you have some options. And
I
you can,
agree.
You can pivot whenever you need to pivot.
absolutely. So if someone needs to get a hold of you, what's the best number to reach you guys at?
I knew she'd ask me, and I didn't bring my card.
You don't have your card? I have my card, but I'll have to pull it out. I wasn't prepared.
Oh, sorry.
I unfortunately, I should have pulled my card out, but I don't spend a whole lot of time
You're
calling myself.
So incredibly unprepared.
I know.
Let me look. I can
That's
actually
okay.
probably.
I
pull-
just know I'm going to get a lot of calls, and I'm going to obviously I'm going to give them your contact information.
Well,
but
I'll look up
tell
our
us what your
numbers.
number
This
is
is so
too.
sad.
So, but in the meantime, I appreciate you guys coming, and we want to bring a shout out to the sponsors that we have is Dispatch Health, Mobile Urgent, and ER services, and then Savior Hospice of the Valley. So tell us what your phone number is for people who need to know.
Lydia just wanted to see me put my glasses on.
I do. I
That's
wanna
what
see
she
you
was
put
up
your
to.
glasses.
She said that he's got to put these on. My direct line is 480
Uh-huh.
582
Uh-huh.
1754.
Okay, so that's 480-582-1754.
And we are, we have a team, but Aimee and I cover a lot of Arizona. So
Yeah.
we cover, we're in Tucson a lot, and
Yeah.
we're in
Payson.
Payson.
Well, what I
Risky.
like about you guys is you're more educating before diving into just
Yep.
getting the loan, because you really, I think, want people to understand what they're getting into.
I'm
know.
passionate
So-
about that.
Yeah.
Because I don't want them to get into this and then go, well, that's not what
I
I
ex-
wanted, or
right.
that's not what I was expecting. I
Right.
want them 5 years. I want their kids to go, that was amazing
The
for
best
my parents.
thing that for
Yep.
my parents. I agree with that. I
Yeah.
agree with that.
We it's funny. We sit in on national sales training calls, and we've determined that we're not good salespeople, but we are good at educating.
You are very good at educating.
You know what?
And you're good with numbers, and that's,
Yeah.
and
That's him.
putting these packages
Yeah.
together. That's what it really
Well,
boils down to.
The people that do these need to make sure that that it's right for them. It has nothing to do with Aimee or I. It's got to
Right.
be the right decision for them.
Absolutely.
We believe in it because you don't buy insurance to use it.
Right. Right.
And there's a
Yeah.
cost associated with this loan, and that's probably the biggest pushback you'll see on these, because you do have to fund an insurance premium. So the costs on these, or we call it the investment in these, are a little higher.
Okay.
But those investments provide you with not only protections, features.
Right.
And you need to look at this more of not a cost structure, in our opinion. You need to look at this as an investment to protect you
Okay.
long term. So.
A lot
Great.
of people love hearing this as just another way that they can not buy long-term care insurance.
Right.
They're opening up an
Yep.
insurance policy with their home, and they can use it
Right.
for long-term care if they want.
And long-term
and they
care-
don't grow out of it. It doesn't
Exactly.
expire on them.
And there's issues with some long-term care policies too that they don't know. And a lot of times you have to get that early enough in life to be able to utilize it. You can't get a long-term policy when you're already sick. You have to get
Yeah.
it before you're sick. So
And
you
this
know,
one, you could get this one when you're sick.
Yeah.
This loan has,
You
this
can.
loan and this access to that money
Right.
it does not depend on your health.
Right.
And
Right.
let's be clear. It's not a federally funded program.
Right.
No.
It is a borrower-funded program. You are paying into the insurance that is protecting you. So
Okay.
it's very similar to the insurance pooled risk environment.
Right.
So I think it's, people need to understand that when they hear the word insurance, why am I paying an insurance premium?
Right.
Well, you're paying for the protections.
Absolutely. Absolutely.
Or your house is paying for the protections.
Right,
Right.
exactly,
The
exactly,
equity in
and
the
giving you a better life too. So just to reiterate, Ted and Aimee, to get a hold of you, it's 480-582-1754. Thank you so much for coming. I appreciate it, and we will see you next week on solving life's next chapter. Thank you.
Thanks, Lydia.
Thanks, Lydia.